So my name is Mary McKenna. I live in Inishowen in County Donegal, and I am an exited technology entrepreneur. I co-founded an online learning business called Learning Pool in Derry way back in the day, 2006. And I built that business along with a more technical co-founder. We grew the business to, we were profitable before the end of year one. We bootstrapped, which if there's anybody on the call that doesn't understand what that means that we built the business without taking any external investment at all. We just built it from within organic revenues of the company, which is a tough call and is a conversation for a complete another hour event really. We grew the business to more than 100 people and 1 million online users, which is quite a significant size of a business, so with a full in-house tech team and the whole shebang really. It was an enjoyable experience, but after 7.5 years, I sold my half of that business because it had grown to 100 people. It had become more of an established type of organization. And to be honest, it was less interesting to me because I'm more of a really early stage startup person. So I sold my half and I disappeared back up into startup land. And one of the things that I've been doing since then, which is about 5 years ago, is I do a bit of early stage angel investment into tech businesses. I'm not a full-time angel investor, which some people are. This is something that I very much do on the side and in things that particularly interest me. And I have 3 key requirements for my own investments. I only invest these days in founding teams that are women, female founders. I only invest in tech projects that are tech for good, so things that are going to make the world a better place. And I only invest in projects where I can actually add something to it through my own experience or through my own network. So those are my own criteria. And the reason that I mentioned that is it's very likely that other angel investors will have the same sort of framework in their own heads. It'll be a different set of criteria, but there will be types of businesses, types of teams, types of things that they're interested in. And since 2014, 2015, I have invested so far in, at the moment, 9, but soon to be 10 companies. Interestingly enough, 2 of those investments will have been made during the COVID crisis, and one of them is into a company where I've never actually met the founders in person. So that's also, everybody will tell you at the moment that it's impossible to raise investment because everything's being done online. It actually isn't. It is possible to do that. So, and for my day job, I work for the EU. I work for the innovation stream of the EU, and I'm one of the people that works on the juries that allocate the EU's huge innovation grants. So I'll maybe talk about that a little bit more. And the last thing I'll say about myself is during lockdown, I have co-founded a new community on the island of Ireland, which is specifically for female founders and sort of female founders that are looking to raise investment. I've done this with 3 of my friends, and it's called Awaken Hub. And maybe Sinead, if you wouldn't mind just putting up the website for Awaken Hub in the chat, so that if anybody's interested in having a look, they can join us there. So today, before we get started, could I just ask how many of you that are on the call are interested in actually raising angel investment? I don't know how we're going to do this unless everybody turns their cameras on, but maybe you could just write it in the chat or something. And how many of you are interested in becoming angel investors? I suspect that it is probably skewed towards people that want to raise investment. So that's lucky, because that's really what my talk's about. And the structure of the talk, I guess I have to start by saying this is really my own personal view. So I can only give you my own personal view. Angel investment's not like venture capital. It's a very, it's a different, more personal thing, as you all know. So I'm going to chat first about some background into finding angels and what I particularly look for in a founding team. I'm then going to move on to 3 pieces of advice for anybody that is raising, and 3 pitfalls to watch out for when you're raising money. And hopefully I'm going to scoot through this at speed so that we leave plenty of time for your questions. So if you just want to be thinking about what questions you might have, and then we'll just come back and do them all at the end. So starting off with finding investors. So as an angel investor, and I know a couple of you on the call are also angel investors, I'm interested in your view on this. I'm often at the receiving end of founders getting this process spectacularly wrong. And this can lead to quite a lot of bad feeling and a bit of frustration on both sides, which is probably unnecessary. And as you all know, it's a bit of a dark art, and you hear plenty of stories from other founders about how they have raised investment. But generally, it is really all about the network. And if you're a person who is sitting there and you're early stage and you don't really have a network, then the first thing that you probably need to do is really start to build out your network. If you've got no idea at all how to do this, you should read Kelly Hoey's book, Build Your Dream Network. That's a great starting place for anybody that's starting out with building their network. Because angel investment is very much, I would say, from my perspective anyway, it's a team sport. So if I have done some due diligence on a company and I've decided that I'm probably going to invest, one of the first things that I will do is I will have a look through my own network of other angels, and I will have a look to see if there's anybody that I know that I think might also be interested in investing. And I mentioned to you that I've probably, by the end of this month, will have made 10 investments. On 7 out of those 10, I've actually brought in other angels with me that have co-invested alongside me. Sometimes it's the other way around. Somebody I know will have seen something and they'll come to me and say, do you fancy coming in on this with me? But the reason that I mentioned that is it is very much a team sport, and it's something that people do together. And in Ireland, it's a fairly tight-knit community of angels, and everybody tends to know each other. And so I think this, and I will only really engage with people where I either already know them or I've had a warm introduction to them from somebody that I know. Now, this may be a controversial thing to say, because there are other entrepreneurs and other founders out there that will say that they have found angels through the most, the strangest of ways. They've met them in a shop and started chatting to them. They came round to their house to deliver a parcel that had accidentally gone to them. That's somebody I know found one of his investors that way. But generally, taking that sort of like random approach to finding people is probably not a great one. And so I would always advise you to look for that warm intro. And the things that you should not do, I suppose, is sending people pitch decks cold on LinkedIn. That whole sort of spray and pray approach isn't a great one and doesn't really work for me. I tend to ignore those types of approaches from like cold emails from people that I don't know. Other angels who do this as a sort of a more full-time thing, and maybe people that don't work in the startup space and struggle with deal flow, perhaps they may be more receptive to that type of approach. And I have got a little article that I'm going to share for you in a second in the chat, which is about how to write good notes so that you get a yes. But my preference would always be that you look for a warm intro through somebody that you know. They do say that in Ireland, it isn't 6 degrees of separation, it's probably more like 2. So you should be able to find somebody that knows the person that you're trying to reach. And I guess the second part of this is I am always really surprised at people who approach me to invest in their company, and they haven't done any homework at all on me. So they don't know anything about me. They don't know the sorts of things that I invest in. They don't know the sorts of companies that I'm interested in. And I often sort of wonder to myself, like, why are they doing this? Do they just want somewhere that they can practice their pitch? I'm quite polite. I probably aren't as rude to people like that as many of the other people in the ecosystem may be. So I suppose the first thing is to say, you should do some homework on who is actually interested in investing in a company like yours. Once you've narrowed that down to a short list, the next thing for you to find out is who from that list is actually actively investing at the moment. The investment cycles are driven by, the tax year, whether people have a certain amount that they're going to invest in the calendar year and they're maybe maxed out, whether or not it's complementary to other things that they do, blah, blah, blah. So that's sort of, and the other thing that you can do is you can do this through one of the formal networks like HBAN. And if people are more interested in knowing more about that, we'll come back to that during the questions. So, I suppose the message really is that it does take a long time to find the right sort of investors for your business. And when you're shopping for people to invest, you really shouldn't settle for people that don't feel right to you or that behave badly. Respect yourself and respect your business idea more than that, and keep on looking, because if people are behaving badly before they've even invested, I promise you that once they're shareholders, they will really behave much, much worse than that. And then I'm going to move on to, and the last thing on that, never ever send your pitch deck cold to strangers that you know on Twitter via a direct message or anything like that. I think that's a really terrible thing to do. I think it really damages your credibility with the potential investors, and it just shows that you are just desperate and casting around wildly without any real plan. And I guess the last little bit on this is when you do get an introduction and somebody speaks to you and wants to know more about your business, you have to really learn to do this in a way that is hustling, but is hustling in a very nice way. And if you're not able to do this, it will flag to the investor that you're probably not going to be very good at selling either. So whatever it is that your business is about, it's unlikely that you're going to do a good job of sales when you get to that. So some of the things that I look for when I'm investing, I look for obviously a sizable market. I look for authentic and honest founders. I look for people that have got deep domain knowledge of what they're actually promoting. I look for people that are aware of the competition, the direct and indirect competition. It's surprising how often you chat to people, and when you ask them, have they heard of such and such a business that you think is maybe quite similar to theirs, they turn around and they say to you that they've never heard of them. I like the tech, because I'm a tech investor. I like the tech to be in-house or in a place where it's going to be easy to bring it in-house. I like the founders to be honest about the traction that they've made in terms of sales. I invest very early stage, so I will be the first money into a company. So maybe there isn't any sales yet, but I still would prefer the founders to be honest about where they are with that. I look for founding teams that are resilient, and I look for founders that can front the business confidently without being too arrogant or too smart-ass. And the last bit on this little bit is I actually really need to like the people too. I'll come back to this later, but people invest for different reasons. I don't invest solely for the purpose of making money. There's got to be more than that. There's got to be more to it than that for me. And when I invest in a company, I'm investing because I actually genuinely want to help that founder be successful and move their business on to the next stage. And it's probably going to be a long haul. I think about it in terms of it being between maybe 5 and 7 years. And I am far too old and too cross to want to spend 5 or 7 years of my life working with people on a certainly like a weekly or maybe even daily basis that I don't like. So I'm not going to put myself through that. So I actually have to like the people too. Red flags for me, know all founders who are not coachable, have got unrealistic valuations, founders that are dishonest, a founder that's got more than one focus, I would walk away from, a founder that shows that they can't respond to change, or they're not able to pivot during due diligence process, and also a founder who is any of the below: anxious, needy, deluded, arrogant, ego-driven, greedy, selfish, brattish, indecisive. There's probably more. And also, the last thing to say on that is something that is plainly just a bad idea. And so I'm going to just trot on here to some bits of advice for anybody that is, a few notes here to keep myself on track. So people that are, some advice for anybody that's fundraising. The first one is start early. Start way before you think you need to, because it's probably going to take longer than you think. And I would say that on average, it probably takes between 6 and 9 months from you having that first conversation with somebody to them writing a check for you. And there is a lot that you can do to get ready. If you're very, very early and you're just in the time when you're thinking about a business, you can start by building out the network that we talked about earlier. Introductions do really, really matter. The second thing, as I've already mentioned, is to do your homework, but do your homework about the type of investor that you want. Is it an angel, or is it a venture capital fund? Is it something different? Is it a private equity firm? Go online and look at plenty of pitches from other, if you're a first time, go and look at plenty of other pitches, learn about all the jargon that exists around the whole fundraising piece, and there's an awful lot of it. If you're not an accountant, it's probably a good idea to learn about balance sheets and learn about cap tables and why they actually matter to investors. And think about the sort of money that you want to bring in. Do you want, maybe you do want dumb money. Maybe that's just what you need. You don't actually need somebody to come in and help you with your sales, or help you with market entry, or any of the other things that angels tend to cross over into. You just want somebody to provide you with money, and that's a different sort. That's a different sort of search that you will do. And then think about what the realistic valuation is for your business, and how much equity you're prepared to part with. We'll come back to this in the questions, I think, but this is this is something that isn't really that black and white. In my company at Learning Pool, we did go through a whole process when we were about 12 months into the business, where we went to raise some venture capital, and we went through the whole process of pitching and getting the term sheets. And I have to say to you that the day that I received the term sheet was probably one of the most disappointing days of my life, because there was a huge gap between what we as co-founders thought the business was worth and what the VC valued it at. So, that's just something to keep in mind, is the valuation. And start working on your pitch early, because it will go through an awful lot of iterations. And before you go to look for money, make sure that you've accessed all the free money that exists in terms of grants, from Enterprise Ireland or Invest Northern Ireland and the EU. The money that you can get through the EIC Accelerator is not insignificant. It's €2.5 million, and it's free money. And then the third tip here is to raise enough. The process of fundraising, the first time that you do this, is extremely time consuming. It's a serious distraction to your usual business as usual. Gillian Doyle here in Donegal, who's the founder of Cerebrian, spoke at one of our Awaken Hub events recently, and she said that when she's fundraising, she dedicates 3 full days of her working week to fundraising and nothing else. The investors are unlikely to be available for you to chat to at the weekends, so it is going to, it's going to eat into your working week. So be aware about that. And watch out for tire kickers, you know, the people that will meet you. I mentioned that 6 to 12 month period. There are people who will meet you every day of the week, and they'll have a coffee with you and they'll chat away with you until the cows come home. But they never actually get to the point of saying to you that they're interested in investment and how much they're actually going to put in. And so it becomes a bit like one of those long drawn out courtships. But the day will come when you do need to pop the question and have that conversation with them, and either it turns into something or you move on. So I'm finishing here with the pitfalls and things to watch out for. So the first one would be that your documentation. You get an investor who's interested and wants to chat to you, and they ask you to send them some information, but your information isn't in the right format, or it's not ready to go. So you have to have your business plan in place. You have to have all your chapters separated out, because people will be more, some people will be more interested in finance, some people will be more interested in your marketing plan. So you need it all split into chapters, all of it labeled up and all of it ready to send out over and over again, so that you can do that without it taking up a lot of your time. You need to have things like your share registers all clear and up to date, no anomalies, all your customer contracts to be in order, all your financials filed and your company filings done, everything up to date there. Your board minutes written up and signed. And no last minute surprises for the investors. It's better to be transparent at the beginning than it is to lead somebody up the garden path and then have to be truthful about something that you've hidden. And I would say that your financial forecast, to be prepared in detail. And if you're not comfortable with this, it's probably something that you need to get comfortable with, to understand your numbers and to be able to answer any questions on the assumptions that are in there. Second pitfall, giving away too much equity early on to the wrong investor or the wrong investors. So this will either put future investors off altogether or current investors off altogether, or it will cause you a lot of heartache and a lot of potential embarrassment. If you have to perhaps go back to a family member that's on your cap table and tell them that your Series A investors don't want them there and have asked you to get rid of them, things like that are a little bit embarrassing. So, and then on the other side of it, I suppose, really do your homework on people that you're talking to as angels. So this isn't a one-way street where I am just interviewing you and doing due diligence on you. You need to be doing the same thing on me. You need to know about the other businesses that I'm invested in, and you need to go and have a conversation with some of the founders of the businesses that your potential angels have invested in, and ask them whether or not they delivered on what they promised at the time that they invested. And if it's smart money particularly, ask them if that has worked out for them. And then the last thing that I'll leave you with this afternoon is, I suppose, just wanted to talk briefly about the difference between a company pre-investment and post-investment, and for you to be prepared for the change that happens. Things might have been very informal for the first couple of years that you're trading. Maybe it's just a few of you and things are kind of casual, and this does change once you've taken some money. You might continue to perhaps be the figurehead, but this may change over time. You'll have investors that you're now accountable to, who will expect you to give them information in a certain format on a regular basis, and for you to be prepared to go through that with them and account for any differences between the forecast that you made when they invested and where you are actually now with the business. And over time, your investors, depending on what the arrangement is, may decide to replace you. And that's something that you have to be prepared for. You'll still be a shareholder and you'll still own part of the business. And when it eventually gets sold, you'll still make some money. But I suppose this comes back to the reasons why people start companies in the first place. And, you have to realize that once you take that external shilling in, it does change things and you become more accountable. So there is a wealth of information online about angel investment. There's a lot of information on the Awaken on the HBAN website as well, and resources on there. And there is a bit of light reading on my own blog, which I will put up, and you can have a read of that. Put it up in the chat in a second. So, who would like to? Thank you. And who would like to start the questions?